What's up, guys? So today we're going to talk about how Warren Buffett would spend his first $1,000 if he were starting today. It's pretty much the four filters Berkshire Hathaway uses to get an average of over 20% a year since 1965. So I'll have a link below to this website, 25IQ. Or you can steal it from off of this link right here. You have to start with a video actually, and I'll cut away to that. Let's check that out.
We have to deal in things that we're capable of understanding. And then once we're over that filter, we have to have a business with some intrinsic characteristics that give it a durable competitive advantage. And then, of course, we would vastly prefer a management in place with a lot of integrity and talent. And finally, no matter how wonderful it is, it's not worth an infinite price. So we have to have a price that makes sense and gives a margin of safety considering the natural vicissitudes of life. That's a very simple set of ideas. And the reason that our ideas have not spread faster is they're too simple. The professional classes can't justify their existence if that's all they have to say. I mean, it's all so obvious and so simple. What would they have to do with the rest of the semester?
Okay, so the guy that you just saw is Charlie Munger, and he is Warren Buffett's right-hand man at Berkshire Hathaway. Charlie, pretty much, he started the conversation. We have to deal with things that we're capable of understanding, and then once we're over that filter, we need to have a business with some characteristics that give us, and on and on. So the first thing we're talking about here is the capable of understanding. So in the circle of competence, we have to deal with things that we're capable of understanding, is what he said. There are a lot of things we pass on. We have three baskets: in, out, and too tough. We have to have a special insight, or we'll put it in the too tough basket. All of you have to look for a special area of competency and focus on that. Now, this is a quote from Charlie Munger, and there's actually, on Warren Buffett's desk, there's actually a box, a too hard box. I'll try to get an image of that up here for you. Warren also has a picture of baseball legend Ted Williams. His happy zone is what they like to call it. And then I got a thing here. Let me go. So this is Ted Williams' strike zone. This is pretty much the green zone here is the sweet spot, what Ted would call his happy zone. That's where he would always hit a 380 to a 400 batting average in this area. Really good batting averages when he would hit in that range. So he would avoid pretty much anything else. Ted Williams, since he's a baseball player, he only has 3 strikes that he can avoid. So if it's a strike and it's in that zone, he's not going to swing at it. He has to swing after a while. Unlike baseball, we can wait forever since there's no strikes for sitting in cash. So this is the number one part of Warren Buffett's way of investing. Go with what you know, circle of competence. You got to invest in some companies that you understand, and you avoid the other ones, kind of like how Ted Williams will take swings at the places where he knows he's going to knock it out of the park. So you need to have your own circle of competence that you can understand and be able to invest and make good money. Next is going to be moats. So where Charlie said, after we went with capable of understanding, once we're over that filter, we need to have a business with some characteristics that give us a durable competitive advantage. So for that durable competitive advantage, it's we're getting into moats. And inside of moats, what we're dealing with is there's 5 different possibilities of a moat. Supply side economies of scale, which would be like Samsung, Intel, and Walmart. With those companies, nobody's going to be able to take them out because they have the supply. They have the ability to price down and get people to buy from them versus the convenience store down the street. Next, we have like the demand side economies of scale. And that's like your network effects, kind of like Twitter, Facebook, Google. That's the places you're going to go to because they know what they're doing the best. Number 3 will be your brand. So that'll be like See's Candies for the West Coast, Coca-Cola for the world, Nike, BMW. For number 4, we're going with regulation. A regulation moat would be something like Moody's, and they're in the bond market, and they do their rating system. S&P for like the S&P 500. Fannie and Freddie working with the government for housing type of stuff, so that they have their moat. You can invest in these companies and they're not going to go anywhere because they've been regulated and nobody else can step in and take their spot pretty much. For the 5th spot, we got patents and intellectual property. This kind of goes back to Coca-Cola can have a little bit of the patent kind of thing, and I believe they didn't even get their patent established because there's a set time frame if they do their patent. So Coca-Cola maybe not exactly because they didn't really do a patent, but they do have intellectual property. Also, other companies that deal with that is like Qualcomm and Lubrizol, so they actually have a lock on the market with their product that they made, and that's how they're good to go. After we do the moat, we're going to management, and Charlie mentioned that and said we would vastly prefer management in place with a lot of integrity and talent. And that pretty much bases on the business needs to have leadership that is better to, so it's better. Sometimes you could even say that you don't need the manager as much as the moat. Better to have a great moat than a great manager, but if you can, get both of them. The only duty of management is to widen the moat. So pretty much the manager is going to be there to support the moat. And when Warren Buffett and Charlie Munger actually invest in companies, they go ahead and try to get management that's already in place with integrity, because if it's already established, why would you try to build up something new? They never really go in and try to do anything. So in this article even says that when they do engage in company management, they focus on capital allocation and compensation systems. And if those two need tightening up, they'll go in and do that, but they do not micromanage their CEOs very much at all. They don't want to go in and make any changes to the company. They want to buy a company. They're investors. So they want to spend the money, get the product that's already there, established, tried and true, and then keep on making more money with that company, and hopefully they don't have to tighten up management. So after we have management in place with a lot of integrity and talent, finally, no matter how wonderful it is, it's not worth an infinite price. We have to have a price that makes sense and gives a margin of safety considering the normal vicissitudes of life. And that gets into the margin of safety. So Warren Buffett and Charlie Munger do not want to spend too much money for a company. When you're investing, you are searching for significant mistakes made by others, and when you find a significant mistake, you bet big. So that's the market kind of always has a price out there, and if you have a margin, it's a built-in cushion allowing for some losses to be incurred without major negative effect. So if you do make mistakes choosing a company for those first 3 filters, as long as you have your margin of safety in place and you can understand the valuation of the company, you're going to have a nice little buffer in case something goes off. And like usually Warren would love to buy a company at 50% off. If you can do that in a few years, you don't expect it to be tomorrow or the next week or next month. It could go up like that, but the company just needs to double up to get to its 100% price. And as long as they can keep making more money with cash flow, you're going to be fine. In investing, margin of safety incorporates valuation considerations to determine a price target and a safety of margin that discounts that target. By purchasing stocks at prices well below their target, this discounted price builds in a margin of safety in case estimates were incorrect or biased. So this is pretty much how Warren and Charlie have taken Berkshire Hathaway to making 20% a year since 1965. That's the way that they would do this. And if you want to know specific companies, you have to go through those filters, find out what you know personally yourself. You need to be able to understand it, your circle of competency. You want to find a company that has a moat that will not be able to get taken out by somebody else. Coca-Cola will not get knocked out by another random cola company that wants to put their drink right next to Coca-Cola, because people will walk into a store and see Coke and see blah, blah, blah. and they're always going to grab a Coke because they know it's tried and true. Management. So when you have a company that has a manager like Jeff Bezos or John Mackey with Whole Foods that got bought by Amazon, that's something great you're gonna want to jump on. That's two different Amazon companies right there, but they have a good little business going themselves. You want your margin of safety will be your fourth filter. You get 50% off on a company, and then if you can get some cost basis worked into it with selling some puts to buy into the company, selling some calls to a crazy high price, you'll get your own little dividends worked into the company by itself, and you can't do too wrong with that. All right, have a good day, guys.